Hi, welcome to our channel. Have you ever wondered what strategies do investment bank traders use? Today, I'll talk about one of the most commonly used trading strategy, the covered call strategy. Before we dive into it, I want to do a quick review on what a call option is and how it's priced. A call option is a financial contract that gives the buyer the right to buy the underlying asset at a specified price, we call the strike price, within a specific time period. We often price the call option based on the Black-Scholes model. I know it's a giant model, but don't be scared. It's actually more friendly than you think. All we need to know for now are the following two variables. First, time to maturity. Time to maturity has a positive relationship with the price of the call, meaning time value diminishes when the contract approaches expiry. Second, volatility of the underlying asset. The higher the volatility, the higher the call price. You can think of volatility as the likelihood of reaching your strike price, but this metaphor is not 100% accurate. I'm just using it to help you understand the relationship between volatility and call price. The structure of this strategy has two components. First, you need to own the underlying asset. Second, you sell the call option on the same asset. For example, you can buy 100 shares of company XYZ and sell one call option contract on the same stock at the same time. Note, one option contract represents 100 shares of stock. The benefits are that it can boost your return and reduce loss. The risk is that you're actually putting a cap on the potential return. I'll demonstrate it by using a real-life example later in this video. The payoff looks like this. When the stock price is below the break-even point, the covered call strategy uses more than just holding the stock. But when the stock price is above the break-even point, holding the stock is better. What I mean by break-even is when both strategies give you the same return. The break-even point is basically strike price plus call premium. If you don't understand this graph, it's okay. I'll walk you through an example later. To calculate the payoff, we need to consider the following three scenarios. First, if spot price is greater or equal to strike price, your profit will be strike price minus purchase price plus call premium. Second, if spot price is less than strike price, and spot price is greater or equal to purchase price, your profit will be spot price minus purchase price plus call premium. Thirdly, if spot price is less than purchase price, your profit or loss will be spot price minus purchase price plus call premium. Now it's time for a real-life example. This is a screenshot that I took from Yahoo Finance. It shows the spot price for SPY and its chain of call options. SPY is an ETF that tracks the S&P 500 index. As we can see, the highlighted call option has an expiry date of June 17, 2022, a strike price of $4.80, and a premium of $6.25. If we buy 100 shares of SPY at the spot price and immediately sell one contract of the highlighted call option, after market closes on June 17, 2022, we'll get one of the following three results. If spot price is equal to $500 per share, That's when spot price is greater or equal to strike price. Your profit per share is $69.28. If spot price is equal to $450 per share, that's when spot price is less than strike and spot is greater or equal to purchase price. Your profit per share is equal to $39.28. If spot price is equal to $400, that's when spot price is less than purchase price. Your profit or loss per share is negative $10.72. If we only buy 100 shares of SPY at the spot price without selling the call option, we'll get the following results. In the case of spot price greater or equal to strike price, your profit per share is $83.03. In the case of when spot price is less than strike price and spot price is greater or equal to purchase price, your profit per share is $33.03. In the case of spot price less than purchase price, your profit or loss is going to be negative $16.97. Now, let's compare the covered call strategy to the just buy and hold strategy. In the first case, when spot price is greater or equal to the strike price, buy and hold wins. In the second case, when spot price is less than strike price and spot price is greater or equal to the purchase price, covered call wins. In the third scenario, when spot price less than purchase price, covered call wins. As we can see from the result, the covered call strategy wins 2 out of 3 times against the buy and hold strategy. That's why investment bank traders use this strategy, because it has a higher probability of winning and lower risk. I personally like this strategy is because it's simple and effective. If you have any questions regarding this topic or have anything that you would like us to talk about in our future videos, please leave a comment down below. If you like our videos, please subscribe and smash the like button. You can also follow us on Twitter and visit us on the website www.ironhawkresearch.com. We'll be posting weekly market commentary and articles about things that you might want to know in finance. Thank you very much for watching and hope to see you next time.